Silver futures trading explained. What if you could profit from the price of silver going up or even going down without ever touching a single silver coin or bar? That's exactly what silver futures trading allows people to do. But here's the catch. While some traders make thousands of dollars from silver futures, others lose money incredibly fast because they don't fully understand how the market works. So in this video, we're going to break down silver futures trading in simple terms. We'll cover what silver futures actually are, how traders buy and sell them, what moves silver prices, real-world trading examples, the biggest risks beginners need to know, and tips for getting started safely. By the end of this video, you'll understand the basics of one of the most popular precious metals markets in the world. Section 1. What are silver futures? Let's start with the basics. A futures contract is an agreement between two parties to buy or sell an asset at a specific price on a future date. In this case, the asset is silver. Instead of buying physical silver bars or coins, traders buy contracts tied to the future price of silver. Think of it like making a deal today based on what you believe silver will be worth later. For example, if silver is currently trading at $30 per ounce, a trader might buy a silver futures contract expecting the price to rise. If silver later climbs to $35 per ounce, the contract becomes more valuable, and the trader can sell it for a profit. But if silver falls to $25 per ounce, the trader loses money. Simple in theory, but the market moves fast, and prices can change dramatically in a short amount of time. Section 2. How silver is traded in the futures market. Most silver futures trading happens on major exchanges like the Chicago Mercantile Exchange, often called the CME. Silver contracts are standardized. That means every contract represents a specific amount of silver. A standard silver futures contract usually controls 5,000 ounces of silver. Now here's where things get interesting. You usually don't need the full value of the silver to trade the contract. Instead, traders use something called margin. Margin is basically a deposit that allows traders to control a much larger position with a smaller amount of money. For example, if one silver contract controls $150,000 worth of silver, the trader might only need to put down $10,000 to $15,000 to open the trade. This is called leverage. Leverage can increase profits dramatically, but it can also magnify losses just as quickly. That's one reason futures trading is considered high risk. Section 3. What moves silver prices? Silver prices move for many reasons, and understanding these factors is extremely important for traders. Let's look at the biggest ones. 1. Inflation. Silver is often viewed as a store of value. When inflation rises and paper currency loses purchasing power, investors sometimes buy precious metals like silver and gold. That increased demand can push silver prices higher. 2. Interest rates. Interest rates set by central banks, especially the Federal Reserve, can strongly impact silver prices. Higher interest rates often strengthen the US dollar and make non-yielding assets like silver less attractive. Lower interest rates can have the opposite effect. 3. Industrial demand. Unlike gold, silver has massive industrial uses. It's used in solar panels, electronics, medical equipment, electric vehicles, batteries. If industrial demand increases, silver prices may rise. This is one reason silver can behave differently than gold. 4. Economic uncertainty. During financial crises or geopolitical tensions, investors often move money into assets they believe are safer. Silver sometimes benefits from the safe haven demand. 5. The US dollar. Silver is usually priced in US dollars. When the dollar weakens, silver can become cheaper for foreign buyers, increasing demand. When the dollar strengthens, silver prices may face pressure. Section 4. How a silver futures trade works. Now let's walk through a real-world example. Imagine silver is trading at $32 per ounce. A trader believes prices will rise because inflation data came in hotter than expected. So the trader buys one silver futures contract. Remember, one contract controls 5,000 ounces. So even a $1 move in silver equals $5,000 in profit or loss. That's a huge reason why futures trading can become dangerous quickly. Now let's say silver rises from $32 to $34 per ounce. That's a $2 increase. Multiply that by 5,000 ounces. The trader made $10,000. Sounds amazing, right? But now let's reverse the scenario. If silver drops from $32 to $30 instead, the trader loses $10,000. And because futures trading uses leverage, losses can exceed the amount initially deposited. That's why risk management is critical. Section 5. Buying versus selling silver futures. One unique feature of futures trading is that traders can profit in both rising and falling markets. If a trader believes silver prices will rise, they go long. That means buying a futures contract. If they believe silver prices will fall, they can go short. That means selling a futures contract first and buying it back later at a lower price. For example, a trader believes silver is overvalued at $40 per ounce. They short a futures contract. If silver later drops to $35, they profit from the decline. This ability to trade both directions is one reason futures markets attract active traders. Section 6. Benefits of silver futures trading. So why do people trade silver futures in the first place? Here are some of the biggest advantages. 1. Leverage. Futures allow traders to control large positions with smaller amounts of capital. This creates the potential for large gains. 2. Liquidity. Silver futures are heavily traded, meaning buyers and sellers are usually easy to find. That makes entering and exiting trades faster. 3. Two-way trading. Traders can potentially profit whether prices rise or fall. 4. Hedging. Businesses and investors sometimes use silver futures to protect themselves from price swings. For example, a jewelry manufacturer might buy silver futures to lock in prices before silver becomes more expensive. Section 7. Risks of silver futures trading. Now let's talk about the dangers, and this part is extremely important. 1. High volatility. Silver prices can move rapidly. Major news events, economic reports, or changes in investor sentiment can create sharp swings. 2. Leverage magnifies losses. Remember that leverage works both ways. Small price movements can create huge losses. Some traders lose their entire account because they overuse leverage. 3. Emotional trading. Fear and greed can destroy discipline. Many beginners panic during price swings and make emotional decisions. 4. Margin calls. If losses become too large, brokers may require traders to deposit additional money immediately. This is called a margin call. If the trader cannot cover it, positions may be liquidated automatically. Section 8. Tips for beginners. If you're interested in learning silver futures trading, here are some beginner tips that can help reduce costly mistakes. 1. Start small. Don't jump into large contracts immediately. Many brokers offer smaller micro silver futures contracts that carry less risk. 2. Use stop losses. A stop loss automatically exits a trade if the market moves against you. This helps control losses. 3. Learn technical and fundamental analysis. Successful traders often study price charts, support and resistance levels, economic data, interest rates, inflation reports. The more informed you are, the better your decisions become. 4. Never risk money you can't afford to lose. Futures trading is speculative. There are no guaranteed profits. Protecting your capital should always come first. 5. Practice first. Many trading platforms offer demo accounts where you can trade with virtual money before risking real cash. This is one of the smartest ways to learn. Conclusion. Silver futures trading can be exciting, fast-paced, and potentially profitable. It gives traders exposure to one of the world's most important precious metals without needing to store physical silver. But it also comes with serious risks. Leverage can magnify gains and losses. That's why education, discipline, and risk management are essential before entering the futures market. For beginners, the best approach is to start slowly, learn continuously, and focus on protecting capital first. Because in trading, surviving the market is just as important as profiting from it. If you enjoyed this video and want more beginner-friendly explanations about trading, investing, precious metals, and finance, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future content. Follow my YouTube channel for more informative videos on metal investing, history, and fascinating true stories. Thanks for watching, and I'll see you in the next video.